Well, good afternoon, everyone. Good afternoon, Billy. Thank you for coming to have a little conversation here today.
Yeah, good afternoon, Alex. On a rainy, stormy Florida day.
Yeah, well, I think we could use quite a bit of rain as far as I'm concerned. So we'll take it, especially on a day where I'm inside in front of my computer. I might as well rain outside.
Yeah, let it skip raining on the weekends and it can rain
Right,
5 days a
right,
week. Yeah, right,
exactly.
exactly. Yeah.
All right,
Well, good to be
so
here.
yeah, thank you, Billy. So let's talk about these topics that we are going to go through today. Here we have a few things that we want to discuss. We're going to start with a college ramen dinner, and then we're going to talk about how it's a big world after all, um, and then we're going to wonder if the funds can outfox the producer. We're going to revisit Corn Econ 101. We can never have too much of that. And then we're going to talk about the Federal Reserve. So why don't you
Mm.
kick us
Are
off
you
with
saying that they're
your
going to be past tense, Alex, or are you
well,
implying something there?
we can get into that part. I was thinking more in terms of being a little shy, but let's see how we go down that rabbit hole when we get there.
Okay,
Let's
excellent.
start. Let's start with your college dorm situation here.
Yeah, right. Well, so um, I had to do a little quick Google search, and it was probably wrong on this, but since we both have students in college and I've got one more going there here this next year, I thought, well, you know, I don't know if they still eat ramen or not, or if they just have so much spending power that they don't eat ramen like we used to when we were in college, or at least when I was in college. But
Yeah.
so we've gotten a few questions on hard wheat, so I thought we would kick it off with a little bit of hard wheat here.
Hmm.
And I think this chart pattern is extremely interesting. I was walking through this today with one of our colleagues, and I'm gonna I'm a little bit slow on this trigger. I want to get this pulled up in front of me because I think it's really interesting uh, when we're looking at this. And the question's basically, well, why is wheat up? What's going on?
Hmm. Hmm.
And sure, we can attribute stories to it, right?
Hmm.
Dryness in Europe, the Soviet Union production region that's declaring drought, like you've mentioned. What else? What else can you pull off the top of your head as it pertains to wheat?
I mean, issues with what's going on in the Middle East and driving
Hmm.
oil prices up, and maybe there's a spillover effect and things like
Yeah, the
that.
problem maybe with the Straits of Hormuz. You could say
Yeah.
that. You could say, delayed harvest in the United States a little bit, even though we're just really nitpicking around some of these things, right? But what I
Hmm.
what I found was pretty interesting in my conversation was, I want to take you way back to March, where we had penetrated the 21-day volume weighted moving average to the upside, and then quickly fell back down below it. And then the market basically challenged it for a string of about 10 days, 12 days, something like that in nature. And then we divorced ourselves to the downside. And then here recently on what was it, the 20th of May, we breached it to the upside,
Hmm.
and the markets basically used that as a level of support
Yep.
until the till the 9th of June, where we broke back down through it. And then lo and behold, it didn't like it down there anymore. And we went back up over the 21-day volume weighted moving average, challenged it from the upside, and then we just launched from there.
Hmm.
I would argue that sure, we had some information in the marketplace, but really this looks like a good old fashioned short covering rally to me.
Yep.
It just drove, the funds couldn't take it anymore, and they just said, "Hey, we gotta." I don't necessarily think they said we need to get the heck out of here, but they thought for a better day, right? They thought we'll take our capital off the table and fight another fight for another day here.
Right. And if you think that they've been short since March, basically, it's been a good run. Let's take our money now. There's no reason to be a hero and risk all that profit for another 5, 10 cents, right?
Hmm. Yeah, exactly. And so
And you know, when you talk about the moving averages, you know, I do think that we talk about that a lot. And you know, I don't think I'm necessarily picturing somebody at a managed money fund looking at the chart and saying, "Oh, we've challenged the moving average. Now it's time to get out." But we know that a lot of these firms, all of these firms actually, are using significant um, algorithms to help them enter and exit trades. And most of the algorithms that are out there in some form or another are going to be trend following algorithms, right? They're in
Mhm.
the end, they're a lot more complicated than that, but it all kind of comes down to that. And if you have a trend following algorithm, you know, it probably flipped from short to long right around that time. So last Friday or so, right? Thursday, Friday.
Right.
And if you get that signal on your screen and you've been short for 2 months, you get out.
Mhm.
It's that simple.
Right. And it doesn't matter if it's drought in Russia or whatnot. This just adds fuel to the fire in a way, right?
Mhm. Right.
So, anyway, so I wanted to show so, and I think that this is interesting in the makeup of the market and why I think it was a significant short covering rally here is when you go to the when you look at the managed money net position and the short where we are relative to the 10-year range.
Mhm.
um, and then remind everybody this is as of 2 Tuesdays ago.
Mhm.
This data is so. You know, there could be more to go here. You know, we're breathing today. You can make an argument that it's, you know, it's had a massive rally over the last 2 days. We're taking a little bit of a breather. Um, and, you know, we also have hedging pressure coming into the marketplace this weekend. As
Right.
you were talking about, what was it you heard about Kansas this week for this weekend?
Yeah, that we could have some of the biggest 3 days of harvest that we've seen in many, many years in the state of Kansas. So
Yeah, so I'm
yeah.
sure there's some hedging pressure coming in, and
Mhm.
um, some of that not only for buying it, some pre-hedging and that kind of things as well. So
Exactly.
we'll see. I think next week will be the proof in the pudding if we continue to drive the funds to continue to cover the short position here from the managed money aspect of it, and then wanted to look at the and again, you know, which is interesting. The biggest part of that rally happened on Wednesday
Mhm.
of this week. So we won't see that in Monday's data, right?
Correct.
So
Correct.
we're going to have to wait almost for well, we have to wait 2 reports before we see what the funds were doing as it relates to Wednesday's action.
Which, I mean, some of these people at some of these funds are very smart. Maybe that's on purpose. That they
Now,
started
maybe,
buying on Wednesday, knowing that we wouldn't see the data for that long.
yeah, or at least official data, right? We
Right.
have brokerage houses put data out where they think what is going on and whatnot, but we won't have the official numbers until two
Right.
weeks, basically.
Yep. Mhm.
Okay, and then I just wanted to quickly look at the hard wheat index net
Mhm.
position. And it's interesting in that they're really just almost what I would call a middle of the range, not anything that's you know, laying out one way or the other in my mind when I look at the net position. And it's interesting that their long position is actually over the 10-year range, which is very curious to me in a market that's seeing deliveries and wide spreads and, you know, subjecting themselves to the negative yield roll.
Right.
That makes me question a little bit of some of the things that we've talked about quite often on this podcast and in many meetings. But yet the index short is outside the 10-year range to the downside. And I didn't include those
Right.
charts.
Right.
So
But
it's
that's
interesting.
why we have these charts, right? Because you're looking at just the net, which is the one we have on the screen. It looks kind of uninteresting, but once you start digging, there's something interesting there. I think it's a good representation actually of the market psychology, because you've got maybe kind of the world player who's saying there's a lot of demand for wheat, and we keep seeing tenders, and we keep seeing people looking for wheat, which would put you, you know, knowing nothing else about the market, would put you on the long side. And then you've got the people that are like, no problems here. Kansas is going to be huge, or the US in general is going to be huge, go short.
Hmm.
And so we have this discrepancy of opinion, and eventually it gets resolved in the market, obviously, by price action. Um, but I think that's a good view of where people might want to be.
Yep, right. It's just interesting when you look at the breakdown and how different they are in terms of
Right.
the 10-year range, and even when you look at it versus last year.
Mhm.
We're just, last year at this time, the index fund short was maybe involved. I mean, it's, was
Mhm.
at the one standard deviation level from the 10-year average, but it's very curious to me when I look at the breakdown relative to the net, which just shows you nothing.
Right. And I mean, as you know, I'm a big proponent of the breakdown. That's why we publish it every week. I would encourage people to look at it because, again, when there is a divergence between the two, if the long is super long and the short is not involved, then you have one opinion basically.
Hmm.
But if the
Right.
long is long and the short is short, and net you're not really anywhere, there's a story somewhere there. So I think
Yep.
it's useful to look at that breakdown. I'm glad you did
All
that,
right.
Billy.
Let's move to the next.
All right, that's your last one before I talk about the world for a minute.
Yeah, I forgot I even put this one in there, but I'm glad that I did. 'Cause I think it's important. So this is the July 25 D's 25 hard wheat spread. And it's interesting that we held serve while the market rallied tremendously over the last few days. And we're breaking down a little bit today in the face of, July wheat being down a little bit. But I just wanted to bring this up. We've had a lot of discussions on the calls, on the wheat calls in particular, that we've eavesdropped on. And I say eavesdrop because we are definitely not hard wheat traders. But that basically talking about a low protein situation.
Mhm.
And we're probably going to know a lot more about the overall protein aspect of the marketplace as we look over this weekend in particular and into next week. But one of the questions that I've got in my mind is, what if the wheat is not deliverable, right? What happens in that scenario, Alex? What do you think happens in that scenario that you don't have deliverable stocks? Would that drive
Well,
people to buy wheat and anticipate buy futures contracts because it's a certain percent, it's a certain guaranteed protein level?
I mean, I think if there is a need for that protein level in the marketplace, yeah, absolutely. That's the place
Yeah,
you can force somebody to give it to you, or not, right?
right,
Drive the value accordingly. Yes.
right. And I,
Mhm.
I know I think we've been pretty at Schooler in general. We've been very aggressive with our rolling. Like our most of our shorts are already in the deferred positions against future sales or anticipated future sales. But it's just something to think about. It's like a doomsday type scenario, but it's just rolling around in the back of my mind, wondering what happens to the wheat spreads if we get to this kind of situation. Now we have last year's stocks that are still around, that are higher protein. It's not going to be something that's like just, a moonshot, I don't think, or anything like that. But it might
Mhm.
change the profile of the market a little bit, or
Right.
quite a bit.
Yeah. Yeah, especially if people have not, you know, been disciplined about holding on to their high protein stocks, in anticipation of potential protein issues with new crop. Yeah, there could be and plus we don't know where we're going to be eventually, right? When we average it all out.
Yeah, and if you've
Yeah.
got forward sales on that are protein sales, your only recourse might be the spread,
Hmm.
right?
Right.
Force somebody to find it to you to give it to you, right?
Exactly. So yeah, that's an interesting aspect that I had not thought about that as it relates to the spread, but I think that's a good point.
I mean,
I'm
I'm
glad
not,
you brought
again,
it up.
don't, everything could be fine. No issue, nothing to see here, move along, right? But it's just something to keep in the back of your minds, I think.
Hmm. I agree. Great.
And as I said earlier today, I'm just talking from the cheap corn seats. So
Well, since you're saying corn, let's switch to corn here for a minute.
yeah,
Maybe a world I'm a little bit more comfortable with. So here we go. I've got this chart. I update it every time we get a new WASD, but it usually doesn't change much. They gave us 25, 26 numbers a couple reports ago, so I thought it was time to kind of put that in here. So if you look at this shows you the projected ending stocks for corn on a worldwide basis, and excluding China, because China for years has been showing very, very large corn stocks, and it kind of distorts the picture because everything else looks so small. But as we know, the Chinese stocks, first of all, there's a big question mark as to whether they're accurate or not. We've had this discussion for decades now.
Hmm.
But second of all, they're not exportable supply. They don't really play a role in the flows of grain around of corn in this case around the world, because China is not going to start exporting corn anytime soon. So
Yeah, I'll tell
um,
you how old I am. I remember a time when China was an exporter of corn
right,
in my
okay,
career,
yeah,
right? Yeah,
uh-huh.
yeah. If
So
you had to put them in there, you didn't know if they were coming or not, but they exported some corn.
that's that's a, okay. That's a fun point. That was before my time. Um, but so if you look at it ex-China, I think it's a good representation. And big surprise here, what we see are the big exporters are going to be represented on that chart. So you have the U.S., Brazil, Ukraine, Argentina, that are the four typical corn exporters in the world. I didn't break out, the South Africas of the world, for example, but you've got the European Union. That's a pretty significant player here, as well as Mexico. I was kind of surprised to see that, but it doesn't mean again that there is an implication in terms of corn export capabilities, but maybe the ability to have a buffer for transitioning between crop years. And then you've got the rest of the world, which obviously is a big chunk. um, I just put it on there. But what you've seen is that and I'm going to kind of ignore the last bar here because it's 2025, and we're kind of far away from it. We're just starting to grow that crop in the U.S., in Ukraine, in the EU. Uh, it's not even on the radar for Brazil and Argentina. So this is far in the future. But if you just focus on 24, 25, you can see that there's a significant drop in ending stocks from the previous 3 years. And the only year that we had before that was a big drop was the 2021, right? So, but if you draw a line from 16 all the way to 24, you can see that there's a gradual lowering almost year after year of these ending stocks, which I think is an interesting trend to think about. Um, and the expectation is that this year we had a big break in that trend, and you could argue some of the numbers obviously based on what you think Brazil's crop is that they're in the process of harvesting right now, but it doesn't change the numbers materially. I think that's a good way to think about why the corn export program has been the
Hmm.
way it was for the U.S. in particular this year. Um, Now USDA is telling us we're going to rebound significantly next year, but if you think about that trend line that you would draw from 16 through 23, we would still be below that trend line, right? And I didn't put it on the chart, unfortunately, but you can visualize it. So even though
Right.
there's a recovery and then the stocks in the current balance sheet that the USDA is projecting, it's still not back to that trend line, which is again a declining trend line. So ideally, you would want to get back above it in order to say that we're comfortable with our world corn situation.
So, question for you, Alex.
Hmm.
Assuming China ends up not taking any corn this year, does that would alter the world corn ending stocks, right? You would kind of raise that number at this point in time if they
Yeah,
if they were not to come in and take what are they in them for 10 or 7 million metric tons or something like that?
I think there are 8 or 7. Yeah.
Yeah, yeah. So that would
So
maybe put us about where we are this year if that was to happen. So
Yeah, yeah, that's a possibility. I don't know that I'm believe that yet, but yes.
yeah, I don't
Um,
believe it either. Relative that they're not right. Relative to the still got to get the Brazilian harvest going and the exports out of there, and same thing with
right.
Argentina, right? So yeah, the jury's
S-
still out.
Right. So I think the story is, and I'm gonna put a slightly different version of this chart here just to kind of remove some of the noise. It's just the carry out to use ratio. Um, and again, it's basically the same thing, right? But in a slightly different because you're adjusting
Mhm.
it for usage. Um, it shows you the same thing roughly. And again, it shows you that we're not really going over that trend line, and it kind of puts in perspective in terms of carry out to use ratio. You know, in the period here since 2005, this year we would not have seen anything below that outside of 2012, right?
Wow.
Which, yeah, which kind of really, I mean, when I saw that, I was like, wow, yeah. That's not really what I had in my mind, but I think it does make sense to some extent. So, um,
Well, yeah, that
what
was
I'm
the year where
trying,
the U.S. had to throttle back exports to about, I mean,
yeah,
almost next to nothing, 750 million
yeah,
bushels, if I remember right, something like that,
yeah,
right?
hmm
That's incredible.
exactly. So I think the reason I'm putting this forward is, we talk about, potentially having a big crop here in the US. We talk about having a big crop in South America. We know that's already there basically. And that's going to be in the 24-25 balance sheet. Um, but I think that shows us how fragile the corn situation still is, and there's still where I still, Billy, you and I have had that conversation years ago that we were kind of on a razor's edge situation when it comes to corn. I think we're still there. I think we're a long ways from moving away from that, I guess is what I'm going to try
Hmm.
to say here.
At least
And
maybe
what
another year, right?
maybe another year, maybe two. And what are the chances we're not going to have any kind of crop problem for 2 years in a row in most of these producing regions? We'll see. Time will tell. But I think
Well,
uh, what happens is that the sensitivity to any kind of even perceived crop issue, I think, is going to continue to be very high.
well, not only, and let's add in the fact that, let's say these RVO things stick, right?
Mhm.
And do we see a bigger movement of bean acres in the 26, 27 crop? I think I'm saying that right. Because, yeah, in the
Mhm.
26, 27 crop year and away from corn, you are then you're really potentially flirting with a situation where if you don't have trend line or higher yield, where you could be right back into some troubling areas as it relates to the stocks to use ratio.
Exactly. Yes. So I think we need to keep that broader perspective in mind because, we could get kind of overwhelmed by the whatever it's going to be, the 90, call it 95 million corn acres for this year, right? And on the tail of a gigantic Brazilian corn crop and a very good Argentinian corn crop, right? We could get kind of lulled into a sense of security there when in fact on a global basis, we still haven't really fixed the balance sheet, it feels like.
Hmm.
So that's the
Interesting.
perspective I wanted to bring in terms of a world perspective. And then just to zoom in a little bit further here in terms of South America, because we and we mentioned it this morning, Billy, on our team call here for the Orlando team. Um, we keep reading that despite the big increases in production in Brazil, they've increased their domestic demand so much that we're not necessarily going to see a commensurate increase in exports. And it's a very good story, and it's very believable. However, my comment this morning in the meeting was, I'll believe it when I see it,
Hmm.
because so far, and again, ignore the 25, 26 bar because I don't think it's relevant today. Oops, sorry, went too far. Um, but if you look at um, the bar at the bottom, if you take all of South America and you look at the total exports as a percentage of total production, We've been very stable over time, right? You're somewhere between, and there are exceptions with a 50%, right? But overall, you're 43 to 45% of the production gets exported every year. And that hasn't really, there's no clear, and it, if you could take a longer, I only went to 2015 for clarity, but even if you went further back, there's no clear pattern that this proportion is going down. And until I see that, I'm going to continue to assume that as we get bigger crops out of South America, we're going to see more exports, and that's going to eat into the US's ability to export grain, which I think continues to be my main thesis here for the next crop year, for the US. So going into the fall and early 2026, calendar 2026 export season.
Yes, they're still going to be an exporter, but in coming years, will their domestic capacity or domestic consumption, that's what I mean to say, continue to match the expanded production? Or will
Yeah,
it
and
not? Right?
my thought process again is that until I see proof that it's not the case, I'm going to say, in a way, the increase in domestic consumption is only making it more likely that they're going to continue to expand acreage and invest in yield and all that stuff, so that you're going to continue to see production, and that production is going to stay ahead of domestic usage, so that you can maintain this export proportion to some extent. And maybe we
Mhm.
lose, 1% or a 0.5% every year for 10 years, but that's such a slow boil that it won't be noticeable for a long time. So that's kind of where I'm at in my view of that market. So I think
But
we can't say, hey, all of this is going to be consumed domestically, so we don't have to worry about Brazil being a competitor in the export market. I don't think that's happening anytime soon.
right. Yeah, it's really interesting way of looking at it, and to see it relatively, like, I would say, smoothed out in a
Hmm.
way.
Hmm.
But I think it also though, I'm thinking about it from a counterpoint here a little bit, not a counterpoint to you, but we just talked about that razor's edge, right?
Hmm.
And
Exactly.
it would show how volatile the export scenario out of the United States could be if there was a production issue in South America.
Absolutely. Well, because that's the argument, right? I think, and that's the way I've been using in my mental model is, you know, you add 10 million metric tons of production in South America, you're basically taking a linear portion of that out of the US exports, and vice versa, but it goes both ways, like what you're saying.
Right.
So if all of a sudden you take a good chunk of production out of South America, then it has to come out of the US. And I think that's the world we live in today. So because of the different crop cycles, right? This big dip, and on this chart it doesn't look like such a big dip, but we went from 83 million metric tons of exports to 77. That's to my logic, that's why we have such a big export program this year, because we're making up for that gap. And then next year we're not going to have to make up for that gap.
Mm-hmm. Gotcha.
Which is why I'm carrying a much lower export number for US corn than the USDA is at this time for next crop, new crop. Okay, one
Gotcha.
more chart on that real quick. It's the same chart, but I just wanted to show kind of the breakdown in bushels, because our brains work in bushels. So again, that drop from 22 to 23, 250 million bushels roughly, and I think that's basically what we ended up adding to the US export program. I mean, USDA is now at 2.65 for old crop. They started the marketing year, I think, at 2.3 or 2.4. So that's basically the 250 million. I'm still a little bit higher than that. So um, I think there's some play there, but that's a straight pass through. Now we're adding another 170 or so million bushels, and that's going to be reflected in the crop that Argentina is halfway harvested now, and Brazil is in the process of starting it, right? That's going to get reflected for us, I think, in our ability to export in the fall and beyond. Our
Yep.
lower ability to export in the fall and beyond. If I say that right. Okay. One more chart that I've been working with. So this is, we've had these discussions before. Okay, managed money is really short. They're going to have to come. They're going to, if there's some kind of weather scare, they're going to have to go cover. They're going to lose their shirt. The farmer is going to get rewarded for waiting. Blah blah blah. Right. We hear these conversations, and I think historically, if you take, funds have been involved pretty much since 2008 in a significant way in our markets. I think if you take the broad horizon, there have been a lot of times where the funds have been on the wrong side of the trade, and it kind of has helped the producer. I would say that over the last couple of years, we've seen maybe a shift in that pattern, especially when it comes to corn, where I think the managed money has been able to put on large positions and then cover these positions when the time comes without significant pain. I mean, clearly, if you're short 300,000 contracts and you cover, which is what happened last summer here. So the red area here is the managed money short, right? So you saw they were really short and then they covered all the way to zero and then they went long, which is the green area when they're long. And you can see the line in white is the price of corn, right? So obviously when they bought these 300,000 contracts, price went up, but it wasn't, we didn't go from $4 to $8. We went from $4 to 440. And I think if you're able to cover a 300,000 contract short and only move the corn market by 40 cents, I think you win. Because I don't think the expectation was, oh, when they cover that short, we're going to go up 30 or 40 cents. I think the expectation is that this is going to explode the corn market, right? And it didn't happen. And similarly, I think on the way down, when they liquidated their long position that they had earlier this year, yes, we saw the price of corn go down, but I think it was relatively orderly. And I think overall, the funds were able, and I'm talking about the funds like if this is one entity, obviously there's multiple participants in there, some do better than others, but I think as a group, they were able to keep the majority of their profits in their position.
So what's this one at the bottom? What's that yellow squiggly line down there?
Yeah, that's the coefficient of correlation between the managed money position and the price of corn. And I'm going to tell you what period it is in 1 second when I can remember it. I'm using because this is a weekly chart, I'm using 4 weeks, which is a short period, but it's kind of to show, when there are periods of huge dislocation. So I drew a couple of yellow lines on there when the correlation goes negative, right? Which tells you, okay, in the first case, managed money is going up, and the correlation with the price of corn is actually negative. So it's not like the price of corn doesn't go up, but it's like on a weekly basis, they are able to cover so much more than what's happening in the underlying, and vice versa. They were able to kind of build a long position starting at the beginning of the year. They did drive the price of corn a decent amount, but it wasn't. It was actually they were able to push corn prices up more when they were buying to get long than when they were covering their short, if that makes sense. Which is great. That's what you want. Once you're short, and you cover, you don't want the price of corn to go up too much. But then once you start going long, you do want the price of corn to go up because that works in favor of your position, right?
Right, exactly.
And then when they liquidated that long position, the price of corn did take a pretty decent dip again, but um, I think they've been able to time their exits with other factors. So in the case of a short cover, the time where the U.S. producer is a willing seller, right? Which
Right.
puts a kind of a cap on what you have to pay to cover your short position. So the question
Beat them
is
down, beat them down, beat them down, beat them down. Get a 20-cent rally, and they'll sell you half the crop.
exactly.
Right? They
It's
feel good
exactly
about it. I won.
right. It's. I mean, it's a total. It feels like a total con, right? Like you sucker them into it, and then they feel happy, quote unquote, if you give them a 20 cents rally, when in fact, you've just made 80 or a dollar on the whole thing. So yeah, you're happy to give away 20 cents just to get out.
Right.
So I think there is maybe I don't know if it's an evolution in technology or if they have better tools with AI to monitor uh, producer sentiment or commercial player sentiment, or if they're mining new data. But it seems like we're dealing with maybe a more sophisticated managed money player than we have in the past decade before that, maybe.
It'll be
And
interesting to
and
watch this. Yeah.
Right, exactly. 2 or 3 instances don't make necessarily a trend, but I think that's what we have to watch here because they've built a decent amount of short position here, and we'll see if I think they've added to it here in the last week or so. Um, it will be very interesting to again watch it when it's time for them to exit that position. Watch what happens. Do we get a 20, 30, 40 cent rally, or do we get a $2 rally? Right.
Right.
That will be exactly the proof in the pudding. So that's what I wanted to emphasize there. And I know this chart is not the easiest one to look at, but I was trying to find a way to illustrate my thought process here.
Okay. Well, thanks for doing that. Looks good to me.
All right. Okay. Back to you, Billy.
Okay. So, got a call the other day, basically was saying, why is the July SEP doing what it's doing when I'm having such a hard time buying corn? And I thought, well, we should just take a quick step back. For those of you that get this in your hip pocket, feel free to tune me out for a few minutes here. Um, but I'll probably go through it pretty quickly anyway. And the reason the reason goes back down to Econ 101, and the contract is written as an export contract. The corn future contracts, and the same thing can be said for soybeans, are written as a futures contract. I mean, not futures contract, are written as an export contract. And as such, the delivery system is built along the Illinois River for corn. And over the last, we've been negative to delivery for a very long time. I don't know that I've seen it go positive. We've been in, -1, -2 territory. And then about 2 weeks ago or a week ago, we went to -6. And then we've kind of gone to -4, and we're kind of hovering around that -4 level. In the interim, we've also seen um, barge freight rally along with the
Mhm.
SIF market, and
Yep.
the SIF market has not outpaced barge freight. And as a result, the anybody that's long, as you're starting to stare into first notice day, which is now basically 5 trading sessions away from us after today,
Mhm.
is I can't execute this stuff. I've got to get out. I don't want to take delivery, so I've got to get out. And so we've been witnessing a lot of that in the liquidation of the July contract from those type of participants. And the commercial is not seeing the market set up in such a way that says, I'm going to take bull spreads over first notice day into delivery. And so because of that fact, you end up with the July SEP corn spread doing something similar to what we've witnessed here over the last, weeks, right? Going on weeks at this point, 3 or 4 weeks.
Mhm.
And, we just keep the July continues to lose value to the September. So if we can go to that one real quick, Alex.
Yep.
Um, and the movement this week in particular has been very violent to the downside, where July corn continues to grind or just quickly lose value relative to the September. For those of you that can remember last Friday, I think we closed at like 15 3/4 on that
Mhm.
spread, something of that nature. And here we are this Friday looking at to right now we're 2.5 cents, give or take.
Right.
So inverse. It's been a violent move this week, and Tuesday in particular was the real day where we uncorked this thing to the downside.
Yeah, and it's
I-
been a step by step process. I would argue that, why it's been so violent in this remaining week is that basically the index is out. We know they've already rolled. And I think the managed money has rolled at the same time as the index, because why would you not? You're 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 buying the spread when they're selling the spread. It sounds like a perfect time to roll. So what you've got left is I'm just going to call them commercials as a shorthand, commercial participants in the marketplace. And if you're a commercial participant, you have to look at that math and you have to come to the conclusion that you were saying. Like, I don't want to be bull spread going into delivery because I'm going to get hurt. So
yeah,
I'm going to get
makes no
out.
economic sense to do it. Exactly.
Correct. So I think there's become kind of a smaller pool of participants after the fund and the index were out. And these participants are looking at that math and they're like, yeah, there's no reason to be here anymore.
Mhm.
Get out.
Exactly. There's no sponsor for the July at this point.
Mhm.
At-
Correct.
Today, mind you, today.
Right.
All
But
right,
yeah,
let's
this
move on
is
then. What do you
okay.
got?
Well, I'm just gonna do a quick review of what we heard from the Fed on Wednesday. Obviously we had the Fed meeting, the June Fed meeting. They decided not to change to cut rates or to obviously raise rates, which was widely expected by the marketplace. So no big surprise there. It wasn't a big market mover. However, I think it's important to think about um, some of the more granular information that they gave us. So every two meetings, the Fed publishes their summary of economic projections. Okay, SEP for short. And they give kind of every participant in the committee, which I think there are 19 or 20, I forgot, um, puts together kind of their forecasts for unemployment, for inflation, for GDP, and as a consequence of all of this, for where they think the Fed rate is going to be. So that generates a bunch of tables that you can find in the SCP if you're interested in looking at the document. And one of the most famous ones that comes out of every meeting is what they call the dot plot, which you can see at the bottom right. Each dot represents one of the participants in the FOMC, and it shows that their expectation of where the rate is going to be um, by the end of the year. So you've got the first column is 25, 26, 27, and then further down the line. And typically what you end up with is a much longer line where most of the participants are focused. That kind of gives you the idea of, okay, as of today, if the Fed, still thinks the same thing, this is where they think the rates are going to be. And what you've got this time is you basically have two groups that are lining up at 50 basis points lower than where we are today. And then another group, very, very similar in size, that says we're going to be exactly where we are today at the end of the year. And it's interesting because if you look at the change, so the table that I put on top is the change from the previous SCP, which was in March, to the current SCP. And what you see is the number of people that think we are going to be 50 basis points lower at the end of the year actually went down by one participant. And the number of people that think we're not going to move at all by the end of the year went up by 3. So that's in my mind, that's a pretty big shift. So that's what this shows you here, right? We had 9 participants that thought we were going to have a 50 basis point total cut by the end of the year. Now we have 8, and we had 4 participants that thought we were not going to see any changes, and now we have 7. And this kind of shift has occurred throughout the curve. So if you look at 2026, you've got a similar idea, which makes sense because if you start 26 with a higher rate than you thought you were going to start 2 months ago, then obviously the final rate for the end of 26 would also go up if you think the path is going to be similar. So overall, what this shows is that we are, probably there's a shift in the thought process of a lot of participants in the FOMC. And I think that's significant because that means we're not just on a glide path. We've been seeing the probabilities of 225 basis point cuts by the end of the year in the news for a long time, and that continues to be the central scenario. However, I think that probability has shifted, and I think there's a lot less certainty that we're actually going to see that, which I think makes a lot of sense to me. If you get a chance to go listen to Powell's press conference after the meeting on Wednesday, which is available on YouTube or on the Fed's website, you will see that he actually talks about the impact of tariffs, which they always ask him about in the press conference. And basically what he said is, and I'm going to paraphrase poorly here, probably better to go listen to him in person, but basically what he said is, if we have tariffs, the expectation is that you have transitory inflation. You have a bout of inflation, and then it kind of goes away because the numbers go up once and then they stay up, and it's just a one-time thing. However, last time, during COVID, the message was this is temporary, this is transitory was the word the Fed was using over and over again. And it turned out not to be transitory at all. And we ended up having to hike rates significantly. And so if we have a bout of inflation coming from tariffs, the fear is that the expectation is not going to be that it's transitory, and the expectation is going to be that it is not. Therefore, we could anchor higher inflation expectation, or unanchor, to use the term that the Fed would use, because anchored for them would mean that it's not out of control. Unanchored inflation expectations, and inflation expectations are the game. It's not necessarily inflation that matters the most, it's inflation expectations. And that's what can get you in an inflationary spiral. If that were the case, that would force the Fed to actually raise rates. And I think the more participants, from what I'm seeing on this chart, is that more participants are starting to think about that, and they don't necessarily want to go push rates too low if there's going to be a point where they're going to have to go raise them.
Mm-hmm.
And if they don't lower rates, it actually buys them more time, where they wouldn't have to go raise rates because we're already at a level that's somewhat constricting the expansion of the economy, if that makes sense.
Yeah, I mean, it makes perfect sense to me. But then again, it was my background, right? So, not that I ever worked at the Fed or anything of that nature, but
Right.
it's funny because what just keeps echoing in the back of my mind is velocity, right? Like
Mm-hmm.
when you start talking about inflation expectations, what is the velocity of money? Nobody's even talking about it anymore, but boy, that sure
Nope.
is starting to ring in the back of my mind a little bit as you were going through what you're
I
talking about. And I think that's what Powell's kind of hinting around in terms of them. We don't want velocity of money to get out of control just
Mhm.
prior to an inflationary event that might come because of the tariffs, because boy, you could really explode this thing. And then, you know, we would act, I would argue they probably would act much faster to the upside than they did the last go round.
Right. And so just one last point here to bounce on what you just said. There is also something we cannot ignore, which is a political element to this, right? We've had an administration that's been asking for lower rates and who has been very menacing, I guess I want to say, uh, about the independence of the Fed, right?
Mm-hmm.
And the Fed has an existential need to stay independent, I would say. And so um, if they get to the point where they have to hike, I think that puts them in a very difficult situation, right? Politically,
Right. Sure. Yeah.
where their independence could then be in jeopardy for real. Whereas if they don't cut, again, if they don't cut, maybe that means they don't necessarily have to raise rates nearly as soon as they would otherwise have to, which could be a way to maintain their independence longer or maybe forever, right? I
Right.
don't know if that makes sense. It's kind of game theory here, but I mean, I think that's part of the logic. I mean, they're going to deny it, obviously, but I do think that's part of their thought process.
Yeah. I like the way you're going with that. Makes total sense to me.
So, and
All right, well,
as we've
we've
discussed,
been going. Go ahead.
yeah, go ahead.
Well, I was gonna say we've been going at it for like over an hour now, so I think we should wrap this one up
I
and
agree.
say it's been a good week, and I feel like we're back in the flow a little bit better than we were last time when we came back from a 3-week hiatus. So I feel like we're turning the corner on it. So I'm happy about that. So
I
I hope
am
you have a great
optimistic as
weekend,
well.
Alex, and everybody that
Same
listens
here.
to the podcast today. I hope everybody has a great weekend and a safe one at that, as we're gearing up for significant harvest in Kansas for the hard wheat crop.
All right. Thank you, everybody.
Thank you.
Bye.